information in this video is for educational purposes only and should not be considered financial advice. Investment strategies like leveraging through loans and investing in REITs carry serious risks like I bought the dip and a kept dipping kind of risks. This strategy is generally for high net worth individuals with a solid financial foundation. If your idea of high dash net worth is finding $20 in your winter jacket, this might not be the move for you. It's usually better suited for people aged 25 and older unless you're a financial prodigy, in which case congrats, but why are you watching my video? Before making any decisions, speak with a qualified financial advisor who can assess your situation. Remember, past performance doesn't guarantee future results and markets can be as unpredictable as your ex's text messages. Invest wisely and don't YOLO your life savings. Okay, Matt's about to start talking about some money stuff, so I'm going to stop talking in an ASMR voice while a video of bagels plays in the background. I hope you enjoy Matt's video as he paid me a lot of money to do this voiceover. Also make sure to like, comment, and subscribe to Matt. He seems to be a nice guy and is kinda cute.
What's going on, guys? Welcome back to another video here on the channel. My name is Matt Branch. As you guys know, this is going to be kind of more podcast style content, but I wanted to give you guys advice, and this could be for a younger audience, and I am talking to a younger audience when I'm talking about this stuff, but this absolutely can apply to, you know, people in their 30s, 40s, and 50s. I'm just coming from a place of, I'm young myself, and this is something that it's kind of like giving him advice to my younger self, so like 16 to 21-year-old self. I wanted to show you guys why it is so important to save your first $100,000. It's not just about the $100,000. It's about having no debt, like no credit card debt, no car loans, no stupid bad debt that you have, like most of us have. If you guys could be debt-free and also have $100,000 saved, you guys will be absolutely miles ahead. And that's kind of why I'm making this video today. So there's actually companies in Canada that offer something called investment loans. And these investment loans can range from up to $100,000. And let's say if you have $100,000 already, you don't need an investment loan of $100,000. You could do a 3-to-1 multiplier loan. So if you have $100,000, they'll loan you up to 3 times that. So you can actually have $400,000 working for you if you want to invest that $100,000. Now, this is so important to understand that if you have debt, this will affect how much institutions are willing to loan you. And so if you guys could just be disciplined, keep your money working for you, and you know, stay out of debt, stay clear of credit card debt, car loans, all that jazz. Like I said, I'm speaking to myself because I think when did I got an RS5 at like, I would have been 21. Now I make good money, I'll be honest, but still it doesn't matter if you're making good money, how much investments you have, like stay clear of debt, because even if you want to get your first home, your debt to income ratio will be all whacked anyways. Like, I don't know if you guys know this, but if you're going to apply for a mortgage, even if you have $20,000 car loan and you're making $120K per year, that will actually affect how much borrowing power you have, how much institutions are willing to loan you. Like my mortgage broker told me, he's like, you got to get rid of the car loan because you're literally throwing out hundreds of thousands of dollars of loan that you could have if you just have a $33,000 loan. So that's how crazy it could be. But going back to this investment loan, you can get if you have $100,000, you've saved discipline. If you've been disciplined enough to save $100,000, this is why it's crazy. Institutions will give you up to $300,000 of their money to invest on top of your $100,000. So now you'll be 21, 22, 23, 24, however old you are, growing $400,000 of wealth instantly, right? And this could be invested in the market, and these would be invested in something called a segregated fund or mutual fund. And this is the cool thing. So now you have growing around $400,000 of wealth at your young age. And this is why it's so important. Now, if you wouldn't have saved that $100,000 and you would have went into debt, not only do you have debt, but you don't have money saved, you won't ever have this opportunity. So in front of me, you could see this spreadsheet that I put together. I didn't put together, ChatGPT helped me with this. In the first year, you're growing. Imagine your first year, you grow by 8%, right? I did I did a conservative amount. Okay. Like, so, I mean, the market over time will average 8% or whatever it is. Some of these funds do much more than that. But just for example's sake, I did an 8% return on investment over the next 10 years. And as you can see, and keep in mind, this is all estimations, but still you could do much better, or you would have to wait out the market. Let's say if you ended on a down year. But listen, this is a 10-year investment plan, and you could see, you could look at your first investment year, and you're making $32,000 extra in that year. The market goes up and the market comes down, but over time the market goes up and to the right. It's statistically, you could see this index chart I'm putting up on the screen right now. Usually the markets go up. If you have a 10-year time horizon, you can spend less time worrying about the markets going up and down. You just know over time, you know this is gonna rise. But let's just fast forward 10 years from now. Look at the amount of wealth that you have. And this is when the investment loan's fully paid back. Okay. You can see you've paid a total of $180,000 to grow your cumulative investment would have been $355,000, and that makes a total return of $863,000. Imagine you started this when you're 25. Let's just say, for example, I know I've been going all over the place. Let's just say you started at 25 and you grew these funds, you borrowed the money, and you grew it till you're 35. Imagine having $863,000, right, in your possession at the age of 35. And it doesn't stop there. So if I scroll down even more here, and you go and take this $863,000, okay, you decide to invest it in something like real estate or a private investment company. You know, these companies offer potentially more growth. Sometimes on average, I put here, this is a little bit more aggressive, but this is kind of backing off, a fund that I was tracking. I'm not listing any of the names of the funds yet. If you guys want more advice, you could just book the link in my bio. But as you could see, this is 12% annual return here. And there's a dividend that gets paid out each month. That's down below. But as you can see, your initial investment year one turns into $960,000, and you have a monthly dividend. And this is where the fun part begins, because this is all passive income at this point. The monthly dividend income could be almost $5,000 in the first month. $5,000 is enough to retire, guys. And keep in mind, this is at age 35, 36. Now, here's the cool thing, guys. You can choose to take that income and you could just go screw off to a different country. You could buy that sports car or whatever. Or you could be smart and reinvest this into another business, back into the investment, whatever you want. But this is the power of just saving to $100,000. Now, there's obviously risks to doing this. This is not for everyone. But if you are willing to have a long-term vision, you're bringing the risk right down, because on average, the markets go up and to the right. Now, here's the cool thing. Obviously, you are borrowing money to make money. So there's a little bit of risk. So there's market risk. If the investments decline, you still owe the loan amount, right? You still have to pay back that loan amount each month. There's interest rate risk. Variable rates could increase loan costs. But here's the thing. You know what we like? You know what we really like? When we borrow money, the amount that we're borrowing can be tax deductible, which helps save on taxes in the long run. And even in the short term, if you you're paying it monthly. And like I said before, this is a long-term commitment. Typically this, you want to be committed to this for over 10 years or 10 years at least, right? So that you could outweigh all the ups and downs in the market. So basically what the principle here is we're borrowing to make money. We're not borrowing to look cool. We're borrowing to earn a return. And when we do that, when we borrow money to invest, the interest that we're borrowing becomes tax deductible. Obviously, I'm not a tax person. I'm not a financial advisor or anything like this. I'm telling you from personal experience, okay? And so in my calculation here, I used an interest rate of 6% annual. That's around $18,000 per year to service the $300,000 loan. You do get the tax deduction if it's a taxable if it's a taxable investment and the loan is structured correctly. You could deduct the $18,000 in interest costs from your taxable income, so that helps you save on income tax. So this is like why it's so important to stay out of debt and save your money, because the more money you have, the more money lenders are willing to loan you in the long run and even in the short term. So that's why saving your first $100,000 is so important and what it could do for you. These things are possible. Now, maybe you want to get your first rental property, and that's another reason. Really, staying out of debt is the most important thing, and then saving money is a whole nother thing. But if you're looking to get into real estate or get into just investing in general and using other people's money to make money, staying out of debt is the most important thing, and then having money and saving it is a whole nother thing, and that's just kind of the cherry on top. Because if you have a good credit score and you have not a lot of debt, that's what lenders are looking for. And so yeah, I just wanted to put out this video. It was on my mind. It's something that I've been kind of brainstorming here and something that I'm currently doing myself, and I thought it'd be a value add to you guys. I'm a 22-year-old entrepreneur and investor, and I'm just sharing my knowledge. So if you guys enjoy these videos and you kind of like this podcast style, make sure to like, comment, and subscribe, and we'll see you in the next video. Peace.